Hey, how's everybody doing? This is Alexander Investment Insights, and today we're going to go over another video. This is going to be one of the first videos. I'm going over options and then how Thinkorswim platform works. So today we're going to go over the option chain and how options work and the basics of it. So here we're on S&P 500. This is the main dashboard of Thinkorswim. So here you click in the option chain. They have this for pretty much every single stock. And then they have the dates, right? So they have it through on the S&P 500. They have it for every single day, starting I think 4 weeks. 2 weeks after that day, they have it for every single day. And then after that, it'll come every single week. Most stocks, like corporation stocks, usually just have it every single week or every single few days. So we go into the S&P 500. This would be a Friday contract, would be June 7th, the end of the week contract. I'm going to show you some things here, right? So we have strike set at 36. A strike here, this middle number, is the contract that you are buying. So the strike price, which you would think that the market price of the stock will be at once the contract expires. And the expiration date is that June 7th, that Friday, the last day of the week. So this is when your contract would expire. And here, left side, we have the call side, which means you think the stock is going to go up, and basically right side is the put side. You think the stock is going to go down. So here's how it works. You see that these numbers here are, this side on the call side is highlighted here, and this on the call side is highlighted, on the put side is highlighted here. So that is because the stock price of the S&P 500 is at $528.20. So right here is on the call side. So every strike price that is below $528.20 is going to be in the money. That means that the market price is already higher than what you think the strike price is going to be when the contract expires. So when the contract expires, if you're buying an at the money or in the money contract, like these ones up here, like 522, when you think it expires, it's still going to be above 522 by June 7th, right? So that's pretty much how the in the money contract works on the call side. The out of the money call side here are more cheaper because they have a less of a chance of going up pretty much to like these prices by the time that the contract expires. When the contract gets closer to expirations, these out of the money contracts are gonna get their time value is gonna decrease, and therefore their value are gonna decrease as long as the market price of the stock doesn't reach them and make them in the money contracts. On the put side of things, which would be looking for the contract to go down. Let's say you bought this 525 strike price contract for 551 or 251. When the price of S&P 500 goes down past 527, that's when this contract will increase in value and then be in the money, right? Because the market value of S&P 500 went down in price, raising these costs of these options to increase in price, right? And that's why these are in the money, because these are already, the 534s are already far away enough that when they go, when the market price decreases on the put side, that these will still increase in value. And to summarize how these numbers work, so every number here is 100 shares. That's why option pays more, because each number here is multiplied by 100. So if you're buying a just out of the money contract here on S&P 500 for $2.47, you're really having to buy it for $247 per contract. And if you bought 10 contracts, you'd pay $2,470. And then if S&P 500 went to 530, then this contract would then increase, and you would sell it here. You buy at the ask and sell at the bid, and you would sell it here to whatever that goes. So you would buy at 247, and then it would, if the price of the stock increased, you would sell it at the bid at whatever the bid is then. And the number here between 243 and 247 is the spread. And so I moved over to Apple option chain. I got this June 28 contract open here, and I'm going to talk about the volume, open interest, and implied volatility. Gamma and delta and all these other indicators you really don't need. You really want to make sure that it's over 500 volume. You want the contract to be over 500 volume. You want the open interest to be over 500, and you want the implied volatility to be under 30%. That's critical. Make sure that the volume was once again over 500, open interest over 500, and implied volatility under 30%. And to summarize things up, I'll just give you once again a rundown of how this would work. So we go Apple expiration date June 28th, 2024. I'm going to buy, say, a put for Apple. I'm going to do an out of the money put, a $180 strike price. So I think that Apple is going to go to $180 from $192 by June 28th, 2024. And I would buy that at $86 per contract, right? Because every option contract has 100 underlying stocks beneath it. So I buy this at $86, and once that got in the money, right? Once the market price of Apple went down to 180, the value of these, the ask and the bid, would be increased, and I would sell here at the bid for, let's say it went up to $400, and I would sell it for $400. Thanks for listening, and we're going to go on to the next options video.